our Cypress Ridge multifamily webinar with myself and Machiel and Ulufsa. Machiel and Vili, how are you doing this evening in Centurion?
Yeah, no, thank you, Kevin. It's Machiel Lucas here, and with me, my colleague Willie Ulufsa. We're going to be attending to the webinar tonight, and then welcome to all the attendees. I hope we have a good interactive session, and yeah, we're going to keep it short and sweet, and yeah, hopefully present you this quite a fantastic opportunity in a very efficient fashion tonight.
That's great, Machiel. Thanks so much. We are definitely looking forward to it. I just wanted to let all the people who are on the webinar know, please, as Machiel said, an interactive session is always the best. So please type in the questions that you have throughout the webinar so that we can use that as a way to determine what people are looking for, so that we can provide you with the best information. So without further ado, I guess it's over to Machiel. I think you're going to start with a bit of a background on where and how before we actually go into the deal. Is that right?
That's correct, Kevin. I think it's always good to start off with the bigger picture and to put this in context. So tonight we are going to look at the Wealth Migrate opportunity called PPA Cypress Ridge. It is a multifamily. We'll explain that just now. We also named it Cypress Ridge is the actual project's name, and then the PPA is the actual sponsor that is doing this project with us as our partner in the United States, hence the name PPA Cypress Ridge. So when we bring about additional deals from the PPA group, it will always be branded as the PPA, and that's the reason for this. Right, so without further ado, for those of you that has heard this before, bear with me. We've got quite a few new potential clients online tonight, and I just would like to really impart a little bit the philosophy of Wealth Migrate, how we deal with it, and how do we come to select these deals a little bit from a top-end perspective. So the first thing is we've done quite extensive research in terms of 16 to 17 countries worldwide, and Wealth Migrate has come to the conclusion through the GIT system, which has been spearheaded by Scott, that we look at quite a number of variables, and when we compare these variables, we actually look at these variables to determine which countries make the most sense. The details of the system, the GITS, is explained in Scott's book. So if you haven't got an e-copy of that, please just write in the message bar there that you would like a copy to be emailed to you. And this really explains it. This system is updated with research on a yearly basis. And so from that perspective, our focus is pretty much on three major countries, which is the United States, Australia, and the United Kingdom. We see quite nice opportunities in these countries, very specifically America and Australia. The UK, we've throttled back a little bit. We believe there's opportunities coming with the Brexit, but at the moment we haven't really found a proper partner there, and you'll see why. So when we get to the United States, for those that hasn't been there, it's a tremendous large country, and you really need to understand where do you want to focus. So that's the first step that we started around about 2011 already, to look at really where to start and where to invest in the United States. So the philosophy that we have used is we've started to look at very key drivers that is correlating to the property growth, and these parameters is what I'm going to show you now. So the first thing that we see worldwide, and this is also coming from the MIPIM conferences that Henny and Scott has been visiting for the last few years, is that logistics is starting to play quite a major role in driving property value, and therefore we really need to look at this. So from that perspective, the shift has come a long way with the advent of the internet and etc. That people need to have their stuff faster. They want it overnight, and so as a result of this, the number of let's call it distribution hubs, etc., are popping up all over the world, and they also very much allocated near to airports instead of near to large sports. Large sports still play an important role, but the most important that we see from a property perspective at the moment is the most traveled airports. A second reason for that is the airports also play a very important role in the location of companies that is doing international business. And so a lot of the Fortune 500 companies, as they're called in America, are actually on purposely locating near to these airports, pretty much because it's very convenient to service the international branches. And as a result, at the moment, Atlanta Airport is by far the most busiest airport in the United States, and it's also pretty much, we believe, #1 in the world. So that's a very big plus. You'll see, obviously, Texas there is a #4, and just there, Illinois, Chicago, they're #2, and then all the way on the West Coast, obviously, inbound traffic from the Far East. So from that perspective, these are the most important airports that we see. And then the next thing that we look at is we as property owners would like to ensure that our rights are protected. So we found that in various states, the level of protection for landlords, what we mean with that is that if there is a tenant that is not paying, that it is the sense of how quick and efficient with the legal system you could evict the tenant and your rights as landlord are protected. So we found quite a contrast in the United States from a tenant-friendly down to landlord-friendly. So from our perspective as long-term property owners, it's very important that we obviously have our rights protected, and we looked at that pretty much top down, and we've seen that these states that's highlighted currently are pretty much the states that's protecting your rights the most. So we've got a lot of examples of that, and we believe that's quite important. And when you look at Scott's book, you will also see that one of the key parameters that we look at when we actually choose a country is that the rule of law is upheld. For instance, there's countries that the rule of law is very difficult to uphold in property, and therefore we simply avoid these countries. Second, the third thing that we look at is obviously population growth. In this specific slide, we're looking here at the states that's growing the fastest. But what we have done is we also looked a little bit more closely at the top 20 cities that is growing from a population growth, and that has been sustaining that growth for the last 5 years. So in this specific example, the cities that really comes to mind at the moment is definitely the cities in Texas: Austin, Dallas, Houston. These are very, very dominant states. Phoenix in Arizona over here definitely comes to mind. Here, Charlotte in North Carolina. Atlanta is definitely under the top 20 fastest growing cities continuously. Tennessee, which is just a bit north, and obviously Florida down south. So these are the things that we've seen. And then very interesting up here in Seattle, this is predominantly driven by the Far East. Like we as humans, the shortest route is normally where we start looking, instead of then doing another flight further. I think most of South Africans land pretty much on this side and really actually just stay here almost. So that's what we've seen. So when we go to the Texas, this is really becoming an absolute growth engine in the United States, and it's definitely by far the most active growth in the United States so much so that there's an area which is called the Texaplex, which is this triangle encompassing the two cities, Fort Worth and Dallas. They actually almost grown together of all the activities that's happening here. Austin down here, which is the actual state capital of Texas. San Antonio, which is just below here, and then obviously Houston. These four cities represent a tremendous growth, and from that perspective, this is the Texaplex, and the growth of this is phenomenal. It's this area in Dallas up north is reckoned to be by far the most active developing site in the United States at the moment. Austin is being dubbed as the second Silicon Valley. Apple just opened a campus there of 1.1 million square feet. We actually drove past it. And then Austin is also very well known for the biotech side. And then surprisingly, a little bit non-property stuff. It's the live capital of the United States. A lot of bands are playing here, and obviously a lot of craft beer. So interesting from a non-property perspective. San Antonio's got very large military bases, matter of fact, 5 of them. And why we like San Antonio is that it's also the center of burn research for the United States. So it's huge in that. And in Houston, obviously, from an oil perspective, is there. From a space perspective, we'll go into that just now, the refineries. It's a quite diversified economy as well. So so bringing this together, we from a Wealth Migrate perspective at the moment is focusing on these sectors or these areas in the United States, because that's the combination of the factors that we've just talked about. So the next question is obviously, now that we know more or less the regions that we want to focus, which segments do we want to focus in? So those that know us by now, we've been pretty much focusing on the medical sector, and we want to introduce now the second most active sector that we found is the multifamily sector in the United States. So the whole rationale about multifamily is really, as we know in South Africa and other parts of the world, it's actually known as a block of flats. That basically means that this units, which is typically in this case 252 units, are on a single title with a single management. And the attractiveness of this is that it has a very diversified income stream over these 252 units. So this asset class, next to the medical asset class, has been 3 years in a row shown by the DL Piper report, which is a research publication that we're very much looking after for guidance, has been voted as the second most attractive sector after medical real in the United States. So from that perspective, it's just very naturally that we as Wealth Migrate is also finding opportunities in this sector. Matter of fact, we have been looking for opportunities in this sector for almost 3 years. The big problem with multifamily is that it is a super hot sector at the moment. So first of all, there's not a lot of deals. And thirdly, you can imagine that the partner that we have to work with really must have a super good record in managing this amount of tenants. So we'll talk about that a little bit later this evening, but the specific case, our partner is managing well over 4,000 units in their sister company, which is absolutely one of the critical things that we've been looking for in a partner in order to ensure that once we bought the asset, we can actually maintain and sustain the very efficient way of keeping the leases up, because as you remember, that is really the income stream, and this income stream is really what we're buying. We're actually not buying the units, we're actually buying the income stream, and this diversified income stream is why it is so active. When we look at capitalization rates, for those of you that don't know the term cap rate, It's basically an indication of the yield of the properties, which means that the higher the yield, the less expensive the building is in terms of the operating income divided by the purchase price. So it means that the lower the figure is, the more expensive the actual property is. So from that perspective, you can see that the medical office cap has been really in the region of 6.8%. So you can see different averages, and it's actually going down as low as 6%. So this is typically the medical office space that we've been working in, still extremely attractive. But this is the one that's really caught our eye, and that is the apartment or the multifamily capitalization rates, which, as you can see, from 2002, it's really been had a bit of a hiccup, obviously, in the GFC, but has systematically come down. So you can see the capitalization rate is at record lows, which look at this down here at 5%, and typically the let's call it the garden apartment, as you can see, is 6%. So if you can buy a property which is run about 7% capitalization rate, that effectively means you're buying it below market rate, and that is indeed the case of the Cypress Ridge property, which is at 7.57. So when we find an opportunity that's in this market where we know we already can sell it at a higher price of a capitalization rate of about 6.25, 6 more or less, we have at least a 1% cap rate compression, as we call it in the industry. That effectively just means that we have the potential to buy it cheaper than the market price, and then as a result of that, we obviously can sell it for more. And this is why you will see in this specific case, the property is having quite a good internal rate of return, which my colleague Willie will share with us just now. So the next major thing that we've really looked at is the market research in, very surprisingly, the decline in home ownership in the United States. So Willie, you've done a lot of research on this, and maybe just highlight for us the key points that you picked up from this trend.
Yes, good evening, guys, and welcome. I'm the head of the due diligence and risk analysis. We've seen that if we look at this slide, you'll note that back in the days, the guys that's now in retirement, all more than 80% had to own a house. As you can see, with the generations, it's been progressively declining up to the point where we have what they call the millennials. That's your age bracket from 20 to 35. That's the guys that's now coming into the market, that studied, and they've decided that due to a number of factors, which includes your the home prices being so high. Secondly, the deposits that they need to pay because of the Great Recession, the requirements from the lenders, and as well as what they've seen in the Great Recession, where their folks had a house, and the value of the house sort of went underwater to the amount that they borrowed, and for that reason we are seeing an upward trend with regards to rental rather than owning a house. If we continue, so what you'll see is the 20 to 34-year-olds are progressively increasing since the 90s, and we should see a lot more people coming into that space. And that's also why this asset, the multifamily asset, is such a great vehicle, because of the fact that you are sharing amenities. It makes it much more attractive. It's usually a 1, 2, or 3 bedroom apartment block, which shares spaces with your fellow neighbors. So there's the interaction that they require, and usually what you also see is that your C class or B class properties will mostly have the millennials coming into them, because it's your blue collar workers working in restaurants, and it's more affordable for them. So what we also know is that the economy for the US has been picking up. We're seeing jobs being added progressively since 2008. What we've seen is that the millennials were basically, most of these guys were out of the job initially, but we've seen now that I think the rates is it decreased from 2008 from 12% to now 4.7% people out of a job as a millennial. The unemployment as a whole, and this is what this charts are reflecting, has increased or decreased over the past couple of years. This actually has a positive impact on your rental growth now. As you can see from the chart, it's also been increasing mostly because of the fact that due to the Great Recession, there has been a period where they didn't add any houses, so there was no new properties built, and that's also been compressing these rates to higher levels. What we've come to see now with these charts. All right. The deal summary. Okay, so this is the property, like you can see from the picture, is much what we're seeing as an estate. It is 252 units. Like I explained previously, it's actually made of 1-bedroom, 2-bedroom, and 3-bedroom flats. What we can see, the total purchase price is 15.7 million. Equity requirement is 5.9. You'll note that it's approximately 62% debt cover ratio, which means that we wanted to make sure that we increase our equity component, just for the fact that we know that there's a lot of speculations as to when the US is going to increase their interest rates, and for that reason we started to deleveraging our position and making sure that we have some buffer going on moving into this market. What you've also noted would have been the 19.4% IRR and an average of 7.4% quarterly returns. What I just want to point out here is that this is a 4-year term investment and not a 5-year as we had with the medical buildings that we've done before.
What's the main reason for that, really?
The main reason is our partner, the PPA Group. They've got over 10 years of experience in this sector, and they have found that because of the fact that we are actually renovating some of the internal 200 of the 252 units will be renovated. That means the kitchen and a couple of appliances. We actually get a fully furnished appliances in these properties. So they're replacing that, and that actually it assists us in increasing the rent roll. So what they found was it'll take about 3 years to renovate and rehab all these units, which effectively means that by year 4 you have gone through all of the units because they've already started. I think 50 of the units has already been renovated, and we've seen an increase in this rent roll. And this means that 4 years is sort of your effective point where you've added enough value to this property to exit it.
All right. The location is in Houston. We've looked at Houston specifically in terms of economic growth. Of course, our concern was with the low oil price and Houston being the energy capital of the world. We've looked at that very specifically. And really, what did your research point out in terms of the trend of Houston's dependence for the economy on oil?
Yeah, Machiel, I think what was quite interesting is that even though it's been called the energy capital of the world, they've done a lot of, since the earlier days, having this dependence, starting to diversify into a multitude of various sectors. So what we see now is that they've actually been rated for the past 6 years as the manufacturing capital of the US. We also know that the medical industry, the medical,
Yeah, the research here
Yes.
is basically the largest medical research in the United States. This is pretty much here at the south end, which is, let's call it on 6 o'clock as we talk about the picture. So we've personally seen it now. It's definitely by far the largest medical research.
And I wanted to just add there is that the medical research is actually got the most employees of Houston, and they actually add 10 billion of the gross domestic product for Houston on an annual basis. What we also know is that the Port of Houston is also rated as the biggest port in the US. It actually moves 220 million tons of domestic and foreign cargo. And Houston in itself has also done a lot of work with regards to programs, tax rebates, enterprise zones that they've created to draw and lure in financial guys, financial banks to move their headquarters because of the Texas no tax on the business. The business tax is actually zero.
Yeah, what we found is that Texas has been very cleverly making the corporate taxes zero. That means on a state level, the companies pay zero tax, but on a federal, that means on a national basis, they pay tax. And then regarding the port, as Willie alluded to, is that when they import stuff through these ports, they actually do not charge the import taxes in the state of Houston. They actually charge the import taxes in the state of destination. So that basically means that if a state uses the port of Houston, they get the revenue of the taxes as not Houston. And Houston said that is fine, and it's actually very cleverly because then it supports the harbor infrastructure for a lot of throughput. And then I think really the other major thing that we've seen is that obviously almost the bulk of the refinery concentration of the United States is near Houston, and then the pipelines going up and down from North Dakota and Oklahoma all ends up here in Houston.
Yeah, and even due to this facts that we've seen a lot of energy companies in here, 63 of the world's biggest companies has got a presence in Houston, and it actually, the energy market actually only makes out 40% of the industry, and I think that's been what's very exciting for us is the fact that we've seen a lot of population growth. I think the population growth has been 2.2%, so there's a lot of people moving into Houston, but it's not predominantly just on the energy side. I think it's JP Morgan as well. They are moving their head offices to Houston.
It's actually Dallas.
Oh, it's Dallas, but okay. There's a lot of influx of the financial guys and technology guys moving into Texas area, which is really benefiting the Houston population as well.
Yeah, then I don't know why, but it's very interesting. The northern side of all the cities in the world that we deal with actually show the growth. I mean, if I can just relate that to Atlanta, I can relate that to South Africa. So this northern area is really the growth area. ExxonMobil has just put 40,000 employees here. The Woodlands, for those that doesn't know about it, is by far the largest planned community in the United States. Just something very peculiar about Houston. Houston doesn't have zoning rights, so it's just you can actually build anything anywhere. So what these guys did, they actually did a master plan community. It's got 5 signature golf courses in it, so it's unbelievable. The size of it. Here's the international airport, and then just here on the side is actually the Houston the space control center. And then Cypress Ridge is located here. It's in the oldest suburb, and the urban renewal is moving in this direction. And we've now clearly seen how the urban renewal has caught up with this area. And the speciality of the PPA group is defining, let's call it vintage multifamily, which then they rehabilitate. And then because they rehabilitate it, they can actually charge higher for it. And in this specific instance, really, I think we can raise the rents around about 15%, or is it even more?
Well, yeah, no, it ranges from about 12%, which if we compare it to inflation, the current inflation rate that you're looking is roughly around 1%, which actually means that we are increasing almost 5 to 6 times more than what the inflation rate would be, and that's mainly due to the fact of the rehabilitation of some of these units, and that actually, if we compare multifamily, what's quite interesting is that the average for Texas specifically, just because of the influx of people moving into Houston, I think what's also interesting to note is that it's actually 25% the living cost below the average of the national of the US.
Yeah, that is an interesting point. And I mean, just to give you quick figures there, really, the Texas average is about $450,000. The Californian average is about $750, and the New York average is roughly about 1.1 million. So not only do they not have state taxes, they also have a landlord-friendly system, which is called at will. So it means you can scale your business up and down with your employees if they either not working or you're not doing well. And thirdly, they cap the medical malpractice insurance. So all of these things help a little bit, why Texas is a growth state,
Yeah, and so what effectively this means is that when we look at the rental increases because of the rehabilitation, it affect our capitalization rate, as Machiel already mentioned. The cap rate is actually quite high when we buy into this property. You can note that it's 7.57% that we actually buy this property into, and if we look at the average current market rates is close to 6% that the graph that Machiel showed earlier. This means that even if we just rehab it and sell it at what the market rates is, there's already a substantial amount that we can actually capital gain from this project. So just to recap, it is a 6% rental increase that you'll find because of this, beating the inflation rate. And what we'll see now on the next slide that'll come later is what makes let me just rephrase. What is really happening is that because of the multifamily, multi-tenanted property, you don't have the problem of a lot of people. If you have 10 people leaving the community, it actually doesn't reflect that much as what you would get with a medical office block where you have 10 tenants and now 2 or 3 leave. Then that means technically you've got a 70% vacancy rate. So, and this is also why this multifamily is such a great asset to have, is that you are protected against the occupation risk of tenants moving out. What we also know is because of this population growth and the shortage of homes, just for intersake, is that from 1990 to 2007, the current housing starts are still 30 below what it's been before the Great Recession, which also indicates that the properties being added is also quite slow. So there's new properties like Machiel mentioned coming in onto the northern side, but that's actually not influencing our property to that extent, because we are basically revamping it to 1980 building, and for that reason we also know now it's more attractive for the millennials to come in, because all the new projects, as Machiel also mentioned, is priced at a higher rate, so the rental rate is also quite higher.
Yeah, I think what we also positioned here very specifically is we're also very sensitive to the fact that the international markets is also a bit unstable. So from our perspective, the fact that this is a mid-class B property, it means that in the event that worst case happens with another potential market correction, it means that if people then start losing their houses, they will actually consolidate back into multifamilies. The price points in this rental rate is between 600 and 800, Willie.
Yeah, I mean, our average for this property is 777. The actual national rate, what we saw from the graph earlier, is around 1,250. So even if we just increase it to a half of what the current market rate is, which is 900, that actually means that we've added almost 10 to 12% to the rental row, which effectively increases our capitalization rate at the end of the day. That's also one of the reasons why we see the 19.6% internal rate of return. You ask us, but the average distribution over the quarterly during the course of the year will be 7.4%, but we're still getting up to a 19.6%, which is a bit higher than what we've seen on some of the medical office buildings that we've done before. The main reason for this is because of this kicker of the rent roll, that we actually can add substantially more to it, and because of the term that's only 4 years, which means we get it in the sweet spot. And that's why we get an additional kickback on the capitalization rate that's currently 7.5%, as I mentioned, going down to, we project around the 6% to exit it at the end of the day, which will give us almost a 70% capital appreciation.
I think importantly here, Willie, is the figures or the percentages that we show here is net of fees, and that was basically when you invest via the platform, you will get this paid out as a dividend, and it's a very efficient way of doing it. So Wealth Migrate has really invested a lot of money to understand how to invest in the United States, bring the money out of the United States, and then actually present it in a dividend format to investors on the platform. For those that reside in South Africa, currently the tax rate is, we understand, around about 15% dividend tax. So from that perspective, it makes it very attractive if you are a high earner, which in other cases you would have earned income tax or income, and that will be taxed at your marginal rate, which is normally more than 15%. So I think that is the value add opportunity. Yeah, I think really we are pretty much in the first phase of raising this equity. We are going to close the property pretty soon. So for those of you that's interested, please make your way. We are going to continue raising money even after we've closed the property. So we're going to underwrite it. That means we're going to pay a portion of that through our funding model. If you're interested in our funding model, which is our standard stable income product, you're welcome to inbox us on that. We're not going to go into that tonight. Yeah, so from that perspective, I think the second most important part of the equation that we come to is really our partner in United States, the PPA group. I have been fortunate to visit them now, I think at least 4 times. Really, you've been there now quite a few items. So what is your impression when you met them with me earlier this year when we did the actual due diligence on site?
Yeah, I think it was just their openness and their complete willingness to work with us was just awesome. I mean, they met this Burki from Free State for the first time, and they were willing to move me from Houston to Austin. I traveled with John Latham, their Chief Investment Officer, and I got a good time to spend with him and really understanding their model and to know why they become an Inc. 500 high growth company. I mean, it was also just terrific to visit their offices. They've got over 120 people that's actually working there, and they've actually, as Machiel mentioned earlier, they've actually into property leasing, management and consulting. They also do a bit of real estate development, which I think is a part of our pipeline that we probably will add on later, maybe as our relationship grow. But yeah, they are real people that actually is got a passion for what they're doing, and that you could just see with the professionalism that they're working that, and just the high grade of properties that they've done already in the past has been just terrific.
I think from Migrate, those that know us know that we've got a very strict criteria for selecting our partner. First of all, they must be at least 10 years experience. This guys beat that criteria by far. Secondly, they must be a niche player. They're only focusing on the multifamily segment, and they predominantly do this rehabilitation type of projects. They do also developments. And thirdly, they have a massive pipeline. So we really are focusing on building this relationship, and the idea is that we will work with these people. Just to give you an indication of quality, because of the multifamily market being so active, we've seen that for this specific property there was well over 20 offers, and the PPA group managed to outwit and outbid this 20 others, and it's not necessarily on price. It was really chosen on the reputation of always closing, and the reputation that these guys have from their own relationships. So we're very privileged to have these guys as a partner. They obviously have other people that can help them raise equity, and they specifically very interested in the relationship with Migrate, specifically because we have the ability to bring international investors to them, where they typically are focusing on the actual property itself. Yeah, so from that perspective, I think that's what we wanted to do. For those that haven't seen our track record yet, we're extremely proud of it. The first one that we did was in August 2014, and yeah, it's almost, I think it's well over 2 years now, and so we're pretty much on track what we promised. This deal is doing phenomenally. We've visited every 3 to 4 months when we're there, so that's going well. Our best performer is with HU Properties in Atlanta, Medical 2. That's coming in at 13.75, so it's meeting all those requirements. The deal that we did earlier this year, pretty much on track, exactly as what we promised. We did the Medical 5 deal pretty much in July, and we're going to pay out the first quarterly dividends now in October. So yeah, so you can see we had a very good run with the medical side. We will continue to have a good run. We're working very hard on Medical 7. We're working hard on Medical 8, 9, 10, and 12. We've already identified all of them. But like always, it takes time, it takes due diligence, and we're not skipping steps because we cannot afford any errors. We're working with other people's money, and obviously myself, Willie, that's leading the team that helps us. We can't skip the steps. So for those that don't know, or might ask, where is Medical 5? Medical 4, and yeah, that was one of them that didn't make the due diligence. So yeah, this is what we've done. We also branched into Australia, for those that don't know. In light of our diversification strategy, we're very, very bullish on Australia. We believe there's substantial opportunity. The first one that we brought now was the Kensington on Latham. We've raised roughly about $4 million already. We are closing it in 3 phases. The first phase was 2.8 million in 22nd of July, correct, Winnie?
Yeah.
When we bought the land, then we did the last bit of development cost, which is the 700,000 that we closed in mid-August, and now for mid-October we've got the last 600,000 to close. This project is obviously a development project. It's a project that is what we call a growth project, and that means that you will get income only at the end of the project. So it means that you get the capital appreciation at the end, and we managed to find a very efficient tax structure. So these returns are pretty much the internal rate of return for those of you that still think in the old ways, what money I put in and what money I get out, if you think like that, which is called return on investment after tax, that works. That you're gonna, if you put $100 in, you will get 126 back, where the 26 is your gain. So this is still a last bit for those that is still interested. Like I said, Wealth Migrate's focus is to give you a diversification strategy so that you're exposed to more than one market. And this is the opportunity currently that we're running here. Some good news is we this week's are having our Australian partners out. Henius, chairman, has a very large track record in Australia, in America, and in South Africa in the medical field. Has definitely secured for us a very large pipeline in Australia. So that's also coming on board pretty soon. So as you can see, our themes that we're looking at is pretty much United States, nice opportunity, multifamily, and nice opportunity in Australia. So that's how we ensure, and we're very excited that both of these opportunities are now on our platform. We've done the first listing of on the platform, which was Medical 5. So this platform is just getting more efficient and working quite well. We also very soon will launch a new face to our website. So please look out for that. That's coming later in October. And for those that don't know, we've been selected as the top 3 fintech companies in Africa. So we're very proud of that. So from our perspective, it's very important that our platform and our digital experience that you have on our platform is going to be very important. And I also like, when you guys are going on the platform, give us feedback so that we can see. So from that perspective, I've just mentioned briefly Medical 7. We basically have signed, we're in the process of signing the purchase and sale agreement, so this is what we're planning on. It still can go wrong, so that's why it's under evaluation still, but all things look good for this property. This one will be in Austin, Texas. Myself and Willie did the physical due diligence in Austin earlier in May, Willie.
Yeah.
So we pretty much has ticked all the boxes, but this will come a bit later. Yeah, so from our side, if you are interested in these opportunities, please log on to our secure website, your interest, gather your KYC documents. What that basically means is a certified copy of your ID or your passport, and proof of residence which is not older than 3 months. So that's pretty much the bulk of it. Get loaded, get up, and then once you're up there on the platform, you can upload your money into your, let's call it your wallet, and then you would be ready for investments as they come along. Now, so from that perspective, Kevin, that's what I wanted to address. I would like to give a little bit of opportunity if there's some questions. I haven't seen too many questions. I think, Willie, I think maybe our presentations are getting so good that we have covered most of the questions automatically. I hope to think like that, but if there's any questions, please type it in the box that is there. And then, Kevin, while they're doing that, I would like to ask that you maybe just put up a poll for us. Let's just quickly see who of the attendees are interested, and if you're interested, please vote for us there, or if you don't want to vote, maybe just put in the box if you would like one of our investment consultants to have a chat with you. I see quite a few of them are online, so they're pretty much up to speed. Thank you, colleagues, for being online. Yeah, it's nice to see that you guys are supporting us. Right, so we've got a question here in terms of what I've seen here from Vishalane Naidu. The question is, given the renovation, what occupancy assumptions has been made for the return? Could there be an upside or downside risk? Who is doing the management of the renovation? And what is the cap rate assumption made for the exit of 19 IRR, and what could cause the cap rates to go wrong over time? Sure. Thanks, Bishlane. It's quite a mouthful. Billy, I'm going to answer the easy ones, and then I'm going to leave the difficult ones for you.
Sure.
The exit cap rate has been pegged at 6.25. So from that perspective, that is the assumption of the cap rate. The 19% IRR, we know, you must realize that is an after-tax amount, so it's actually quite awesome. Then what could cause the cap rates to go wrong over a certain time? What can make this is that if there's a market correction, the cap rates can go the other way. That basically means in the market correction, like we've seen in 2008, 2009, is that the cap rates actually increases. That basically means that less people are, let's call it, they can buy the building cheaper. However, what we have also seen is there's also a large movement into property from the equity market at the moment. So on the one side, we have an influx. That means that it's pushing down the capitalization rate. And the other side, we could have an outflux, like we've seen in Brexit at the moment. There was an exit in the United Kingdom at the moment because people were just unsure. From our perspective, the strategy that we use to counter this is that we have deleveraged the building from our typical 70%, 70, 68% loan to value. We've deleveraged to, I think it's 62. So that basically means that we've taken a smaller loan, and therefore the repayments compared to income is a ratio that we look at very carefully. In commercial terms, that is called the debt coverage ratio. And that basically means that how much of your income after expenses you have available to cover your loan payments. And in this case, it's 2.5 times, which is an extraordinary level. Normally, we are happy with at least 1.5 times. In this case, 2.48 times. So, right. So, why I'm telling you that is that it basically means we can stomach a change in capitalization rates. And then, lastly, we've pegged the exit time at 4 years. Obviously, we don't know what the market conditions will be in 4 years. However, the rate of renovation is pegged at around about 3 years. And when we have got roughly a year play to make sure that we're not forced to sell at market conditions that's adverse. It means that we've got a bit of flexibility in year 4, but current indications is that that we're doing it. Billy, let's start with the other questions. What occupancy assumptions have we made?
Okay, yeah. So basically, what we bought the property at a 8.2% vacancy. Effectively, what we know is from the partner perspective, they usually take around 2 weeks to renovate this property. Units, excuse me. So effectively, what that means that some of the units will go offline as when they are basically vacated. If the contract ends, they basically start the renovations. In most instances, obviously, what could happen is that some of these renovations would have already taken place in some of the vacated properties. What they effectively will then do is move some of the current tenants over to these properties to ensure that there's a continuous roll of this, making sure that we are what was built into this cash flow is in the first year we are actually added another 12% of vacancies. So we've actually added a vacancy rate of 12% that we foresee on the proposed rental income that we expect from the property, as well as.
So you artificially then put 4% vacancy in as a buffer.
That's right. Yeah. So we've actually added an additional 4% the buffer, as we've known and as we've seen from representation and from the researchers. There's a high demand for these properties, and for that reason, as soon as the property is renovated, it rolls into being occupied. Okay, so upside downside risks there. Well, what we
got contingency in based on the partner. I think there is a 5 to 6% contingency, if I remember correctly.
That's right. Yes. Yeah. They've actually made provision for this, and like we know, I mean, they manage, like Machiel mentioned, over 4,000 units. That means it's 20 properties that they basically that is currently under their management, and that's basically also them managing it. We just have to just clarify here is it's basically a sister company. I think Machiel actually mentioned it. It's called Clear Management, and what they explained to us, and from our side to try and make sure that we protect our investors, we have the ability to actually, if we're not happy with the management company, fire them. You know, so effectively, the PPA group also said to us that they actually has done it in such an extent to make sure that they can always bring in a new management team. So if we're not happy and they do not, we actually set budgets at the beginning of the year for the year, and if they actually do not adhere to that, or there's a deviancy of around 5 to 10%, then we start going in and basically take over the management.
Yeah, it's a very important question is that Wealth Migrate has put in risk management strategies in the contractual agreement. The first risk management strategies that we've done is that we have made the management contract that can be terminated based on what Willie just said, so we manage them by budget. Second contingency that we've made is that we have step-in rights. That basically means we have the right to get involved with the management of the company should the PPA group is not managing that. And thirdly, we're asking them to contribute to the property. In this specific case, 10% of the equity is coming from the PPA group itself, so that means they will also be investors to the effect of 10% of equity requirement in their own actual property. And then over and above that, one of the key things that our sponsor is doing is they are signing, in this specific case, for a $9.87 million loan, which they are standing surety for, and that I think is also enough incentive for them to ensure everything is pretty much on track. All right, so I think that is the questions that I've seen. Thank you, Vishlin. I hope we answered most of them, but I think it was very insightful for everybody to get your questions. Thank you very much for that. So I haven't seen additional questions yet. Kevin, from your perspective, is there any other things that I would like to address tonight?
Thanks very much, Machiel. As you say, there aren't any more questions, and thanks very much for answering those questions in so much depth. The only thing will be that if you are interested, as we've said, the people who have made comments in line with that. Otherwise, thanks very much, and we will chat to you again soon with our next webinar.
No, thank you for everybody that attended. Please, if you have additional questions, please feel free to shoot it through to your investment consultants. They will obviously feed back to myself and Willie. Yeah, so thank you for being online, and hopefully we see you as an investor in this fantastic opportunity.
Absolutely.
Yeah, thank you. Thanks for the good questions. Keep them coming. It helps us.
Absolutely. Thank you very much, guys, and have a great evening.
Thank you.
Cheerio. Bye-bye.